Bismillahirrahmanirrahim. This is the third video on budgetary planning. In this video, we will solve an exercise on how to prepare a sales budget, a quarterly production budget, a manufacturing overhead budget, a budgeted income statement and supporting budgets, and finally, purchases and income statement budgets for a merchandiser. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video help students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video help fresh graduates who want to refresh their learning on budgetary planning. So let us start with solving an exercise on how to prepare a sales budget. Eddington Electronic Incorporation produces and sells two models of pocket calculators. These are the two models. The calculators sell for a $15 and $25 respectively. Because of the intense competition, Eddington faces management budgets sales semi-annually. Its projections for the first two quarters of 2014 are as follows. We have the sales for the first quarter and the second quarter, and we are required to prepare a sales budget for the two quarters ending June 30. List the products and show for each quarter and for the 6 months units, selling price, and total sales by product and in total. So we start with the sales budget obviously, and we are going to look into the units in the quarter number 1, that is 20,000 and 12,000. So there are 20,000 and 12,000. So the total comes out to be 32,000. The selling price is $15 and $25 respectively, and we multiply units by the selling price to get the total sales, that is 300,000, and this will also be 300,000, and the total will be 600,000. Then the units for the second quarter are 22,000 and 15,000. So the total is 37,000, and the selling price will be 15 and 25, and again the total sales will be units multiplied by selling price, and that is 330,000 and 375,000, and the total will be 705,000. The units for the 6 months will be the units for quarter 1 and the units for quarter 2. So that is the total of 20 plus 22, that makes 42, and $12,000 and 300,000, and that is equal to 27,000. So the total is 69,000, and the selling price is the same, that is 15 and 25. Again we multiply the units by the selling price. We have 630,000 and 675,000. So the total is 1,305,000. Next, let us solve an exercise on how to prepare quarterly production budget. Now, Trendy Car Company produces and sells automobile batteries, the heavy-duty HD240. The January 1, 2014 inventory is 2000 unit. This is the beginning inventory. Management desires an ending inventory for each quarter equal to 40% of the next quarter sales. Sales in the first quarter of 2015 are expected to be 25% higher than sales in the same quarter. We have to prepare the quarterly production budgets for each quarter and in total for 2014. So first we have record the expected unit sales, and this is given over here 5, 7, 8 and 10. So we have 5,000, 7,000, 8,000 and 10,000. To this, we are going to add the desired ending inventory, and it is 40% of the next quarter. So 40% of 7,000 is 2,800. And then 40% of 8,000 is 3,200, and 40% of 10,000 is 4,000. Now for the fourth quarter, you can see that the sales in the first quarter of 2015 are expected to be 25% higher than in the same quarter in 2014. Now in the first quarter, we have the sales of 5,000, and it is going to be 25% higher. That means times 125, and we need 40% of this amount. So 40%, this will be equal to 2,500. So the total required units are going to be 7,800, 10,200, 12,000 and 12,500. From this, we are going to subtract the beginning finished goods, and you can see that beginning for January 1 is 2,000. This will be subtracted, and then 40% of 7,000, that is going to be 2,000. That will be 2,800. Then 40% of 8,000, that is going to be 3,200, and 40% of 10 is 4,000. So we will be subtracting these values. This is the beginning finished goods. So this will be 5,800, 7,400, 8,800 and 8,500. So the total is 30,500. Next, we solve another exercise, and here Atlanta is preparing its manufacturing overhead budget for 2014. Relevant data consists of the following. We have the units to be produced 10, 12, 14 and 16. We have direct labor time is 1.5 hours per unit. Variable overhead costs are per direct labor hour. So that means we have to first of all determine the direct labor hours, and this is 1.5 hours per unit. So we have 10,000 units, so 1.5 times 10,000 is 15,000. 1.5 times 12,000 is 18,000. Then 1.5 times 14,000 is 21, and then 1.5 times 16 is 24,000, and this total will be 78,000. Now we can calculate the variable cost, where we have the indirect material, that is 0.8 into 15,000, into 15,000, and this will be equal to 12,000. 0.8 into 18,000, that is 14,400. 0.8 into 21, that is 16,800. 0.8 into 24,000, that is equal to 19,200, and the total will be 62,400. Indirect labor is 1.2, so this will be 1.2 times 15,000, this is equal to 18,000. 1.2, then 1.2 times 18,000 is 21,600. 1.2 times 21,000 is 25,200. 1.2 times 24,000 is 28,800. So the total is 93,600. Then we go for the maintenance, and maintenance is 0.5. So 0.5 of 15,000 is 7,500. 0.5 of 18 is 9,000. 0.5 of 21 is 10,500, and 0.5 of 24 is 12,000. So the total comes out to be 39,000. So the total variable will be we have 0.8 over here, we have maintenance was 0.5, so the total variable cost per unit is 2.5 per hour, and this we can sum up this thing. The total is 37,500. This will be 45,000. This will be 52,500, 60,000, and this will be 195,000. Then we have the fixed cost, and the fixed costs are fixed, they are not going to change. So that is 35,000 for each quarter for supervisory salaries. And the total will be 140,000. Depreciation is 15,000, and that is also fixed for each quarter, and this is equal to 60,000. Then we have maintenance of 12,000, and that is 48,000. So the total fixed cost will be 62,000. And the total manufacturing overhead will be 37,000 plus 62,000, that is the total variable cost plus the total fixed cost, and this will be equal to this will be equal to 599,500, 107,000, 114,500, 122,000, and 443,000. Okay. Next, let us solve one more exercise, and this is going to be a comprehensive exercise where we prepare several budgets. And here we have Glendo Farm Supply Company. They manufacture and sells a pesticide called Snare. The following data are available for preparing the budget. We have the sales for quarter 1 and sales for quarter 2, and the selling price is 60. Direct material for each bag of Snare require 4 pounds of gum. at a cost of 3.8 and 6 pounds of tar at 1.5 per pound. We have the inventory for snare, gum, and tar, and we have direct labor, and direct labor time is 15 minutes per bag, that is equal to I will talk about it in a minute, at an hourly rate of 16 per hour. Selling and administrative expenses are expected to be 15% of sales plus 175 per quarter. Income taxes are expected to be 30,000, and we are required to prepare the budgeted income statement for the first 6 months and all required operating budgets. All. So we are going to prepare, and do not prepare manufacturing overhead budget or the direct material budget for tar. So we are going to prepare only for gum. So first of all, we start with the sales, and sales is going to be the total sales. And the sales in the first quarter is 30,000 bags, and in the second quarter it is 42,000. So the total is 72,000, and the unit selling price is 60, so we multiply by 60, and the total will be 1,800,000. 2,520,000 and 4,320,000. Now once we have prepared the sales budget, we start with the sorry, with the production budget. And for the production budget, the expected sales is 30,000 and 42,000 bags. The total is 72,000. To this we add the ending finished goods, and the ending finished goods are for the first quarter it will be 15,000, and for the second quarter it will be 18,000. That is equal to 33,000. So we make a total, and the total will be 45,000, 60,000 and 105,000. From this we are going to subtract the beginning finished goods, and the beginning finished goods for quarter 1 is 8,000. We are going to subtract this, and second quarter will be 15,000. So the total comes out to be 23,000 to be subtracted, because this is the beginning balance. So this is equal to 37,000, 45,000, and the total is 82,000. Now this is going to be of relevance for us, and we will talk about it as we progress, so don't worry for this. And once we have prepared the production budget, the next budget will be the direct material budget. For direct material budget, we first take the units to be produced, and they are 37 and 45. 37,000 and 45,000, and the total is 82,000. Now the direct material per unit to be used is 4 pounds of gum. So we multiply this by 4 times 4, and this gives us a total of 148,000, 180,000 and 328,000. To this we are going to add the desired ending direct material, and the desired ending direct material for the first quarter will be 10,000 and the second quarter will be 13,000. So 10,000 and 13,000, that makes 23,000. And once again we make the total, and the total will be 158,000, 193,000 and 351,000. From this we are going to subtract the beginning direct material for the first quarter, and the beginning direct material for the first quarter is 9,000 for the first quarter, and the second quarter is 10,000. So we are going to subtract 9,000, and here we are going to subtract 10,000, that makes 19,000. So that is it. And then we are going to multiply. So the direct material purchases will be 149,000, 183,000 and 332,000. From this we will look into the cost of cost is 3.8. So we will multiply this by 3.8, and this will be equal to 566,200, 695,400 and 1,261,600. Now once we prepare the direct material budget, the next will be the direct labor budget. Now again the units produced are 37 and 45. So we have 37 and 45, and the total is 82,000. Now the direct labor, you can see, is 15 minutes per bag. Now 15 minutes per bag means, if we convert into hours, so this will be equal to 0.25 hours. So 0.25 times the rate is, so first of all we will multiply this by 0.25, and this will give us the total direct labor hours. So this is 9,250, 11,250 and 20,500. And the direct labor per hour is 16. So we will now multiply by 16, and the total direct labor cost will be 148,000, 180,000 and 328,000. So that's how we prepare the direct labor budget. And next will be the selling and administrative expenses budget. Now when we prepare the selling and administrative expenses budget, we look into the budgeted sales, and that is 30,000 and 40,000, sorry, 42,000, and this is equal to 72,000. Now what they say for the selling and administrative expenses are, for the first quarter it will be, for the first quarter the bags are 30,000 and they are selling at the rate of 60, and they are 15%. So times 15%, and this will be equal to 270,000. For the second quarter, it will be 42,000 bags times 60 times 15%, and this will be 378,000. The total is 648,000. Now there is a fixed uh, expense of 175 for each quarter, 175. So the total is 350,000. So the total selling and administrative expenses will be for quarter one, it will be 445,000, and this will be 553,000, and this will be 998,000. Okay. Now, once we have done this, so we have prepared all the budgets, but one thing will be added, that is the cost element, before we finally prepare the budgeted income statement. And we can see that the direct material, that is for gums, it was 4, the quantity was 4 and the rate was 3.8. So 4 and 3.8, that gives us 15.20. Quantity times units sold is equal to the total. For tar, it is 6 pounds times 1.5, and that is equal to 9. The direct labor is again 15 minutes. So 15 minutes, in when you convert into hours, it will be 0.25 hours. So 0.25, and the rate is how much? Sorry, rate is 16 per hour. So 16. So this will be equal to 4. Now manufacturing overhead, they have given over here is 150% of direct labor cost. So 150% of direct labor, that is 4. 150 times 4, that is equal to 6. So the total will be 34.20. 34.20. Now we can prepare the budgeted income statement, and for this we start with the sales. Now we have 30,000 bags plus 42, that is 72,000 bags, and we are selling at the rate of 60 times 60, that makes 4,320,000. Then we have the cost of goods sold, and the cost of goods sold is 72,000 times the rate we have calculated, that that is 34.20, and this will be 2,462,400. This will be subtracted to get the gross profit, that will be 1,857,600. Now from this we are going to subtract the selling and administrative expenses, and selling and administrative expenses were 998. So 998,000. So this gives us an income from operation as 859,600, and from this we are going to subtract 30% of taxes, as it is given over here. So 30% of 859 is 257,880. So that gives us 601,720. Okay. So next, let us solve an exercise on how to prepare purchase and income statement budget for a merchandiser. Now, the budget committee of Litwin company collect the following data for its Sands Miguel store in preparing budgeted income statement for May and June. Sales for May are 800,000. Sales in June and July are expected to be 5% higher than the preceding month. Cost of goods sold is expected to be 75% of sales. Company policy is to maintain ending merchandise inventory at 15%. Operating expenses are expected to be estimated to be as follows. There is an income tax of 30%, and then we have to prepare the merchandise purchases budget for each month in columnar form. So we are going to prepare the budget for the month of May and June. And first of all, let us see how we prepare the calculate the budgeted cost of goods sold. Now the sales is 800,000, and this was for the month of May. So we have 800,000, and from this we are going to have 75% of sales. So 75% will be 600,000. So that is 600,000. And for the second month, it is going to be 5% more. That means 800,000 into 105, or you can say 1.05, that will be equal to 840,000, and cost of goods sold is 75%. So 75% of this will be 630,000. Next, we go for the desired ending merchandise inventory, and this is you can see company policy is to maintain ending merchandise inventory at 15% of the following month's cost of goods sold. Now, cost of goods sold for the following month is 630,000. 630,000. And we want to maintain 15%, so this will be 94,500. Okay. Then we are going to have a long explanation now for the third one, that is for the ending merchandise inventory for the month of June. Now, for the sales for the month of June is 840,000, and it is going to be 5% more, so times 105%, this is equal to 882,000. And then the cost is going to be 75%. So 75% will be 0.75, that is 661,500. And from this 661,500, we have to have an ending inventory of 15%. So this is equal to 99,225. So the total will be now 694,500 and 729,225. From this, we are going to subtract the beginning merchandise inventory, and the beginning merchandise inventory, if you can remember, we have the beginning will be 15% of 600,000. Number 4, 15% of 600,000, and this will be equal to 90,000, and this will be subtracted. And for the month of June, this will be 15% of the cost of goods sold, that is 630,000. So this will be equal to 94,500. Let me check once more. 630,000 into 0.15, that is 94,500. And now we have the required merchandise purchases, and that will be, we are subtracting, this will be 604,500, and this will be 634,725. Okay, now we can prepare the budgeted income statement, and for this we start with sales, and sales for the month of May was 800, and for the month of June it was 840. So we have 800,000 and 840,000. Then we have the cost beginning inventory, and beginning inventory is 90,000 and 94,500. We have 90,000 and 94,500. Then we have the purchases, and the purchases are 604,500 and 634,725. So we have now 604,500 and 634,725. That gives us the cost of goods available for sales. So this is equal to 694,500 and 729,225. From this we are going to subtract the ending inventory, and the ending inventory was, we have calculated before, and the ending inventory is 94,500 and 99,225. So we have 94,500, 99,225. So this is going to be subtracted, and this is amount will be now 600,000, the cost of goods sold, and 630,000, and you can verify this to what we have calculated here is the cost of goods sold. The cost of goods sold. Then we calculate the gross profit, and gross profit will be the sales minus cost of goods sold. We have 800 minus 600, that will give us 200,000, and 840 minus 630, that is 210,000. Next we calculate the operating salaries, and these are salaries are going to be fixed, that is 30,000. Advertising is 6% of monthly sales, so 6% of 800, this is the monthly sales. 6% of 800 will be 48,000 and 50,400. Delivery is 3% of monthly sales, so this is 3% of monthly sales is 24,000. 3 is the 24 and 25,200. Sales commission is 5% of monthly sales, so that will be 40,000 and 42,000. Rent is going to be fixed, that is 5,000. Then we have depreciation of 800. Then we have the utilities of 600. Then we have insurance, or that is fixed, 500. And the total operating expenses will be 148,900 and 154,500. Now when we subtract the total operating expenses from the gross profit, we will get the income from operation, that is 51,100 and 55,500. From this we have to subtract the 30% taxes, that is 15,330 and 16,650. So this gives us a net income of 35,770 and 38,850. So this completes the third video on budgetary planning, where we learned how to prepare a sales budget, a production budget, manufacturing overhead budget, budgeted income statement and the supporting budgets, and purchases and income statement budgets for a merchandiser. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.